ഹലോ ഹരി, നമുക്ക് സ്റ്റാർട്ട് ചെയ്താലോ?
Sure. We'll start here. Oh,
ഓക്കെ. സോ യാ ഇത് നമ്മുടെ ഇപ്പോൾ നോർമലി നമുക്കൊരു 30 ആണ് റെപ്രസെൻറ്റേഷൻ ഉള്ളത്.
uh-huh.
We have 30 continuously attending the cohort
Okay.
sessions. So we are
Mhm.
expecting, but they have a tendency to attend or join the session after 10 or 15 minutes. You
No
know.
worries.
So we are not wasting our time for them. So
Right.
yeah. Okay, let me welcome Hari to the session first of all. So Hari is a close friend of mine, guys, and he's a chartered accountant. He has been with this startup ecosystem for the past how many years? I'm not aware, but
I've been associated right from the startup village days. So
okay,
maybe
from the very
2000.
beginning, yeah.
Yeah.
Okay, so he's also a mentor of Kerala Startup Mission, and he has helped many startups. Whichever I have connected with him, I have got a very good response from the startups, and he can handle this session wonderfully. And Hari, this cohort is focusing on the idea to MVP stage startups. So they are in the phase of building their MVP only. And so they haven't yet decided when to register their startup. So majority of them have the doubt whether we have to think about registering our company right now or later. So we have to learn more about when to register and what is the right time to think about it and how to do it. Many type of registration process are there, and according to the fundraising processes. So we all have such doubts whether to register in LLP or private limited or like that. So we all need clarifications from you from the very base level to the to a level when they are reaching at a scale up stage. What we have to do that right now.
Sure.
So yeah. Also you have some. You can have, sorry, I think some participants may have some doubts regarding CA as well. So you can clarify that as well. And also I will connect some startups personally with you later from this cohort. So
Sure.
this is the process we are following. I think nothing more I don't know to explain about this topic. So Hari will do that
Sure.
from now on. So yeah, welcome Hari.
Yeah. Thank you.
Over to you.
Thank you, Aditya. And then thank you for that introduction. So, good morning, everyone. As she said, I've been right from the beginning. I've been involved in the startup scene in Kerala, and I've worked with a lot of startups, and so I'm someone who closely understands the problems that you face, and I can probably help you with some of those solutions. So if you start off with business or entrepreneurship, there's a lot of exciting things. Like every day is something new challenges, new opportunities, new threats. But then there's always one other side to the business, which is not so fun, which is slightly boring for entrepreneurs. But at the same time, what it does is if you don't comply with those rules and regulations, it can break your business. So it's very important that along with all the fun, the pressure, the excitement of the entrepreneurship, you look after the other side of business aspect as well. So that's why we have this topic here. So the topic given to me by Aditya is navigating legal compliances, corporate governance for early stage startup. She wanted me to uh, one second. Yeah. Is the screen moving?
Yeah.
Yeah. So the topic that I've been given is one, cover legal structures and governance models. Two, ownership, shareholding, and ESOPs. Three, dealing with audits, filing, banking, and taxes. Then I cover other regulations, regulatory compliances, and then importance of data protection and IP rights. So these are all individually, if you look, topics that probably will take half day or full day sessions. But my basic idea is to give you an introduction so that When somebody talks about it, you know what it is, and you have some basic information on those areas so that it will help you further learn and further get information on those items. Okay. So just being in this 1.5 hour session, I'll just quickly move into those topics one by one. First, let's look at legal structures. So when you start off a business, what are the opportunities that you are? How do you register your organization? So that's the first question that every entrepreneur has. Now, and the options that are available to you are one is sole proprietorship. Okay, the sole proprietorship means nothing but you being the business itself. So there's no separate specific registrations that are done. Your PAN card, your the income tax registration for the business. You can take your GST or any other registrations in your individual name. And the only thing that is required is if you're starting up this trading business or something, then there is a Shops and Establishments Act registration that needs to be done at the local panchayat, municipality, or the corporation. And that's the only thing that is required. And then you can start off with the business. Then there's partnership. So when there's more than one person involved in the business, there are two owners. Obviously, a sole proprietorship cannot be the mode of operation. So that's when you move into a partnership. And a partnership involves maybe more than one person. So two or more people, entering into an agreement to do business together. And then you have limited liability partnerships, which means the main drawback of partnership, if you look at the Partnership Act, was that there was unlimited liability. So to bring in the clause of limited liability, I'll explain what limited and unlimited liability is. So it was just purely to bring in this benefit of limited liability into partnerships that the government incorporated a new law for limited liability partnerships. And then the most common one, which is the private limited companies. And then we have something new which has come up recently. So as I said, sole proprietorship has a lot of disadvantages when you're a single man business. But if you are a single founder and you need to get the benefit of a limited liability, the government said, okay, we'll have something like a 1% company wherein an OPC can be registered. So these are basic registration structures available to you when you start a business. Now we'll just look into them one by one. Sole proprietorship. So what are the main features of sole proprietorship? As I said, single owner, and it's not a non-corporate entity status. So there's no registration, specific incorporation or documentation being filed for this kind of organization. The advantage is the tax slab. It is, I don't know how many of you are familiar with the income tax slabs, but as you know, there's no tax up to say 3 lakhs. Then there's a special rebate available to 7 lakhs. And then that's how the tax slab goes. So the exact same tax slab is available for sole proprietorship business. And there is a mandatory audit only if your turnover or your sales exceeds 2 crores. The formation is very simple. And it's best when there is very small capital required, and as in you can fund your own business. And if you are freelancers or anything of wherein you are doing a professional service or something, sole proprietorships are the best option. What are the disadvantages? You have unlimited liability. So what does unlimited liability mean? Unlimited liability means that when you have a loss in the business, when you say, imagine you bought something for 100 rupees or you spend some 100 rupees, you are expecting to sell it for 110 rupees at least, making some profit. But imagine you were able to sell it for only 80 rupees. There is a loss of 20 rupees. So you are liable to give person 100 rupees, but you got only 80 rupees. Where does the balance 20 rupees come from? It has to come from your personal assets. So what it means is, if the business fails, your personal assets become liable, and the courts will say, if you have some land or bank balance or something, take that and distribute it to those people who require the funds. So this is what you mean by unlimited liability. Very simply put, your personal assets become liable for the losses incurred in the business. Okay, so this is unlimited liability. Now, what are the other disadvantages? There is only limited capital available because nobody else is going to invest in your business if the business is in your name, because they need the share, they need to have the ownership if they are putting in money. So this method does not allow you to have that. And then there's no perpetual succession. So what does perpetual succession mean? When you are the business and when you are a single person business, what happens when something happens to you? Imagine you die. The business automatically comes to a stop. So that is why it is called no, it doesn't have perpetual succession. Whereas if you look at limited entities or corporates, they have perpetual succession. And two, and there's another disadvantage, which is if you're looking at international business, they want to look at businesses when there is continuity. This is basically a corollary of a perpetual succession. So they are always get what if the person I'm dealing with, dies? I've given him an advance, he dies. I will not get that money back. So that kind of threat is always there and proprietorships are never favored when there is international business. Also, a point to note, proprietorships are not recognized by Startup India. So Startup India recognizes only registered partnership firms, LLPs or companies. So if you are planning to register as a sole proprietorship, you are not going to get any of those benefits under the Startup India scheme, nor the KSUM registration, unique ID. Now moving on to partnerships. So, and as I said, from a single man business, you're now moving to two or more people. So the Partnership Act says there can be a minimum of two partners, and the maximum allowed number is 100 in a partnership. And this is the partnership is written in it's a stamp paper document. If you're in Kerala, it is on a 5,000 rupees stamp paper that the agreements are written, and it contains all the details of the basic agreement between the partners and the nature of the business, who will control what all activities, what are the salaries that the partners will take, where the registered office will be. All these kind of information would be mentioned in the partnership agreement or the deed. What are the major advantages? Compared to a sole proprietorship, there are more, you can add more people, so more people can bring in money, so more resources available. Then you have a legal compliance, which is easier. Compared to a company or an LLP, the legal compliances are simpler. Again, the audit comes in only if there is a profit of more than below 8%, or if the turnover, if your income is more than 2 crores, if your total sales is more than 2 crores, only then there is a mandatory audit. And this works where you're not looking for external third party funds. For example, your friends and family would always be willing to invest in your partnership firm. But if you're looking at an investor, say somebody who's purely giving you money and is looking only at the financial benefits, looking at selling his shares at a later point of time, those kind of people will not invest in a partnership firm. And the reason is the unlimited liability clause. So I have money, I have a lot of assets. The business goes into a loss. I'm only an investor, but still, because I am a partner, even my assets are liable. So if the court will say, okay, the other partner, the founding partners do not have the money or do not have the bank balance, but your bank balance is there, we will take that money and clear the liabilities of the partnership firm. So because there is a issue like that, a pure financial investor will never invest in a partnership firm. So that is why you have unlimited liability in the partnership firm, and then similar to a proprietorship, there is no perpetual succession. Normally, every partnership comes to an end when one of the partner dies. But there is a thing that you can add in your agreement, which says if one of the partners dies or retires, their legal heirs can be added and the partnership can continue. So if there is a clause like that that is mentioned in the partnership deed, this perpetual succession point can be mitigated. Another drawback of partnership firms is that you have a flat 30% tax. So as I said, for individuals, we had the slab rate. There was no tax till 3 lakhs. And then up to 7 lakhs, there is a special rebate available. So none of these benefits are available to a partnership firm. The whatever is the profit, a flat 30% needs to be paid as income tax. Okay. And similarly, because of the unlimited liabilities nature, and the perpetual succession clause, it is not generally favored for international business, but it is much more favored than a proprietorship firm, that I may add. And then we move to the limited liability partnership. So this is a fairly recent addition to the type of entities. Now, till say the first 50 years of our independence, we didn't have this. And what happened was there was always an issue where all entrepreneurs wanted a simple structure, but they've also wanted the limited liability benefits. And if you looked at the Companies Act, so to the 1956 Companies Act was pretty simple. But when the 2013 Companies Act came in, what happened was it was framed after three major scams that happened in India: the Satyam scam, the Sahara scam, and the Sharda chit fund scam. So because of all these scams, the rules were made very strict in the 2013 Companies Act. And it made it almost impossible and impractical to do some business for small and medium players. So everyone wanted a simple structure with the limited liability clause. And that's when the government came in and said, okay, we will do something like limited liability partnerships. So some of the features are the minimum two partners, and there is no maximum limit. But there is a small uh, problem that this is an online form that needs to be updated. Practically, when you have a large number of members, it becomes difficult to upload the form. But otherwise, if you look at the rules, there is no limited or there's no maximum number of partners that can be there in an LLP. Because they give you a limited liability benefit, they make sure that you do not copy the name of an already existing big firm. So the registrar of companies who are also in charge of or who's the authority for managing the activities of a limited liability partnership, they ask you to apply for a name and making sure that it does not violate the Trademark Act. Because if somebody else already has a trademark in that name, you will not get it. Also, if there is a similar name already existing in the business world, they will not give you that name. And this is now becoming a challenge because a lot of names are already taken. And one more point is they not give you similarly sounding names also. So what that means is, imagine I want to incorporate a company, I name or an LLP, I name it Wipro VIPR. But because there is already a WIPRO Wipro company that is already there, they will not give you this name. So the point is similarly sounding names are also rejected. So when you replace S with Z, C with K, these are all places where they identify it as similar names and they reject your name application. Now this is a corporate version of the limited of the partnership, and it's very similar to the LLC or the various other forms available across the world. And it's most suited for professional services or service companies wherein you don't need too much external fundings. So although it has limited liability, there is one drawback. And that is why financial investors never invest in limited liability partnerships. So if you go to a professional investor like an angel investor or a PE fund or a venture capital fund, they will never invest in a limited liability partnership. They'll ask you to convert into a private company. If they might be interested in your business, they'll say, convert into a company and then we will invest. Now, what is the reason for that? The reason is when LLPs are entered, it is again a stamp paper document. It's a deed or an agreement wherein all the partners sign. Now, imagine you've given 1% stake to an employee or you have a minute small shareholder. When the investor comes in, the new deed is entered, everyone signs, the investor puts in the money. And now, for any financial investor, an exit is imminent. He'll wait through 2 years, he may wait 3 years, but maybe 5 years, depending on his risk appetite and his profile. But at the end of the day, he wants an exit. So, being a stamp paper deed, even if a single person does not sign this stamp paper agreement, what happens? The deed is incomplete and his exit is stopped. So, he cannot transfer the shares or the ownership that he has. And that is why you don't see many of these people investing in limited liability partnerships. Now, being a new act comes with its own disadvantages also, because uh, the cost of formation, the legal compliances, the penalties for legal compliances. So what it means is, even one form, there is a delay, there is a penalty of 100 rupees. So you forget to file one form for a year, you're looking at a penalty of maybe around 40,000 rupees. So from a small business's perspective, the numbers can be big. Again, the tax rate is also on the higher side at 30%. But one small advantage is audit is there, but audit is there only if your turnover is in excess of 40 lakhs or your total capital investment is in excess of 25 lakhs. So if you are a small LLP, there is no audit. Only if you are a big LLP or slightly a revenue generating LLP, audit becomes mandatory. So these are the features of a limited liability partnership. And now we move on to the most common ones, the private limited companies. So I'll just quickly I'll just slowly increase my speed so that we cover most of the topics. I know we have 20 minutes on. Yeah, sure. So limited liability partnerships are covered. Now we move on to the private limited companies. Minimum two directors and two shareholders are required. The shareholders can be the directors themselves. So at least minimum two people are required. The private limited company says minimum 200, maximum number can be 200 shareholders. And the moment you cross that limit, you need to mandatorily convert your private company into a public company. The unique name which was there for limited liability partnerships is also here because the registrar of companies is the governing authority for both of these type of entities. The charter documents are called the memorandum of association and the articles of association. So basically, when you form a company, these are the two documents that you submit with your registrar of companies, along with all the other documents. Memorandum tells you what the name of the company is, what the capital is, who are the promoters, where the head office will be registered, and all those kind of information. And articles of association is like the bylaw. So it tells you what are the rules and regulations within, how the meeting should be held, who are the director board members, what are the, if there is a minimum shareholding criteria required for directors. All these kind of internal bylaws are mentioned in the articles of association. And this is the most common form of business if you look. Advantages include the limited liability, perpetual succession, and you can the angel in all the professional investors would invest in these kind of entities. The disadvantage, of course, it is the legal formalities are much on the higher side. Tax rates are slightly lower than the partnerships and the LLPs, but still 25% or 26% based on the tax rules that you take. But one major drawback is you have mandatory audits and annual filings. So even if there is no transactions in your entity for the whole year, you are mandatorily required to get your books certified by a chartered accountant and your annual filings have to be done. So, for the question, when should form into a separate entity or when you should form a company, the answer is when you are when you have the option to invest money for these kind of activities, when you have a clear idea. If you look at if you are immediately looking for external funds, these are the times when you will have to mandatorily form a company. Till that point of time, I would definitely suggest you going it alone or going it alone as a simple agreement with a partnership firm or even a sole proprietor if you are an individual. Move into a company only when you are aware that if you look at the annual compliance cost, you're probably looking at maybe around 30 to 35,000 annually for even if there is a hardly any activity in the company. So be prepared to shell that money out when you're forming a company. If you can hold it till then, do that. Because I see a lot of company people coming in to form companies. I tell them, don't rush into it, but they're like they're desperate. They quickly open, they want to do it quickly. And by 1 year, your company or your business has not reached anywhere and you're burdened with this huge liability. And which tempts you to default. And the moment you default, you're looking at the bigger penalties like 100 rupees per day. So if you look at annual compliance for companies, if you do a default, you're probably looking at maybe a close to 1 lakh penalty if you're delaying it by a year because just the interest costs. So think twice before forming an entity. Try to run your business. Try to develop your products before that, and then only move into this legal structure. Oh, sorry. Yeah. And another concept that the government has introduced, as I said, so sole proprietorships have the unlimited liability issue. So what government said is, okay, if you are a sole proprietor, if you are a single person, for the time being, you can start a one-person company. But being a one-person company also requires two people. So the fun part is, although it's a one-person company, you should have a nominee who would take over the company in case of something that happens to you. So effectively, it's still two people, and probably that is one reason why it is still not very popular. Although I do a few of them, but they're not very popular. Uh, Again, if you are a sole proprietor, you get the benefit of the tax slabs. Here, you don't get that. You don't get third-party investors also coming in because there's only one person that is allowed. So at that point of time, the conversion needs to happen. And also the mandatory audit clause comes in. So because of all these, one-person companies are not very popular, but they are there, especially when there's just one founder. He's not sure whether he'll find a co-founder or he's still maybe, he's waiting to find the right co-founder to move into a private company. So there's an option to convert a one-person company into a private company. Now, the next point, shareholding. Shareholding. So again, I just quickly mention the points to remember. Uh, there's a concept called authorized capital and paid up capital. So when you form a company, authorized capital is the maximum capital you can issue. The company can issue, and this is it's kind of like a permission given by the government. And paid up is the actual amount that has been invested into the company. So a lot of people misunderstand authorized capital and paid up capital. Authorized capital is not the actual capital. It is basically a permission given by the government to say you can raise up to this capital. But the paid up capital can be actually much lesser. So a common thing that I see is an authorized, when you form a company, I see that it's a 10 lakh authorized paid up capital, authorized capital, and the paid up capital will be maybe 1 lakh or 50,000 or 10,000. There's no minimum limit to the paid up capital when you form a company. And authorized capital is important because it is based on the authorized capital that government fees and stamp duties are determined. So the higher the authorized capital, the higher is the government fees for filing each form. So whenever you file a form, there is a fee that is paid to the government. So the fee depends on the authorized capital. Then again, as I said, two shareholders, the maximum is 200 for a private company, and if it's more than 200, it is mandatory conversion to a public company. And the moment you turn public, a lot of rules come in. A lot of rules means it's difficult to comply when you're a small company. A lot of filings, including annual filings, quarterly filings, website required from website requirement, the details that you need to publish in the website. There is an entire list of things that you need to follow when you have a public company. Another point that I wanted to discuss is the shareholding pattern when you form a company. So we, as professionals, we always say avoid 50-50 ratio. Even if there is two founders, try to avoid a 50-50 ratio. The reason is, in case there is a dispute, the entire business comes to a standstill. So we always say try to have a 51-49 or a 40, even a 48-48 or a 49-49 with a 2% to an independent, somebody who's not directly influenced by any of the other two investors, if there is a third person. Do something like that so that there is always a one person, at least there's no situation where both of you are equally powerful, and a dispute can happen wherein a person might want to what do you say take one decision, but there's an opposition from the other side. When there is a dispute, the decisions get stuck. Nobody is able to finally take a decision because each have equal share, and then the company comes to an entire standstill. So I've seen this happen, and it is something that is from a formation point of view. So something to keep in mind. If there are three people having three equal shareholders, doesn't create a problem because two people standing together will have more than 51%. So the majority decision works. But in this 50-50 scenario, there's no majority. So no decisions can happen. Every shareholder has some basic rights. These include rights to attend vote at AGM. AGMs are annual general body meetings. EGMs are extraordinary general body meetings. And common decisions taken at these meetings are adoption of your financial statements. So every shareholder has the right to see the balance sheet and profit and loss account at the year end, has a say in deciding who the auditor is, has a say in deciding who the directors are. Any changes to the memorandum or articles of association needs their permission. If you want to issue new shares, debentures, employee stock option plans, all these require the permission of shareholders. But there are two methods in which the shareholder decisions can be taken. One is a simple majority. If you have a lot of decisions can be taken through a simple majority, like appointment of directors, appointment of auditors, appointment of adoption of financial statements. All these are places where you need only a 51% majority. But there are decisions like AOA alteration, MOA alteration, issuing shares where a special resolution needs to be passed, which requires a 75% of all the shareholders present there voting in favor of those resolutions. So these are the few points to remember from the shareholding perspective. And then we move on to the ESOPs. So ESOPs basically stand for Employee Stock Option Plan. Okay. So when you have employees who are working right from the beginning, most startups might not be in a position to make the payment in cash in full. And at that point of time, ESOPs are considered as a good option, wherein you promise somebody that you will give them shares, which would at a later point of time, they would be able to make money from those shares. So that's what ESOPs are basically. These are also called sweat equity. So basically, it's equity shares given for the effort or the sweat that they generate for working for the company. Now, what are the processes involved in this? One, the first step, excuse me, I'll just drink some water. I've got a slightly sore throat, so sorry for that. Uh, Drafting an ESOP is the first step. Okay, so basically, the scheme has to explain about who the eligible employees are, how much shares will be issued, what will be the vesting schedule, what will be the exercise price, what is the period involved for the exercise, and basically all the other key terms and conditions of an ESOP, which will like what happens when an employee leaves the organization in between. What if someone dies in between? Somebody who has an ESOP employee, but he dies. So these are all the conditions that are explained in detail in the ESOP scheme. And once the scheme is drafted, it is taken to the shareholders and the board approves it and it is taken to the shareholders. And as I explained in the earlier in the slide, ESOPs are one of the areas where the shareholders need to vote and approve. And once the approval is received, you have to inform the ROC and get the ROC's approval for ROC is the Registrar of Companies. So ROC's approval for the scheme. Once the scheme is approved, you issue grant letters to all the employees who are eligible to get the employee stock option, and those who are interested, you enter into separate agreements with each employees. And once you do that, you are required to maintain a register with the ESOPs. There's a specific format provided in the Companies Act with the name, address, the number of shares that are allotted to him, how much vesting is done, how much is the exercise. There's a specific format that is mentioned in the Companies Act. It's called SH6 format. And the register, you'll have to maintain it like that. And when the actual allotment happens after the vesting period, when the exercise happens and the shares are allotted, there is another form that you need to file with the ROC. This is the process. Also, every financial statements, whenever you prepare a balance sheet and P&L account, you need to mention certain details about the ESOP scheme and the number of shares under ESOP and all those information. One catch or a negative of the ESOP, which prevents a lot of startups from not enter into an official ESOP plan is the last point, evaluations during year end and at the time of allotment. So now what happens is the moment you create a plan and issue allotment letters, for every financial year end, you are required to value the ESOPs that have been given. And this has to be done with a registered valuer. And a registered valuer can charge you anywhere between 25 to 1.25 lakhs, 25,000 to 1.25 lakhs, depending on the registered valuer for valuing these ESOPs. So this becomes a big burden for small companies and startups. And that is why most startups refrain from actually entering into a legal filed document for ESOPs. So this is something you should always keep in mind when you are planning an ESOP policy. Now, I will move on to the mandatory filings required once you form a company. Every year, you are required to file an AOC 4 form, which is your annual filing of financial statements. and it has to be done within 30 days of the annual general meeting. Similarly, your annual returns have to be filed within 60 days of the general body meeting. And the details required are your profit and loss account, balance sheet, everything forms part of your financials in the AOC 4. And MGT 7 shows the shareholding pattern, the director's details, and all other information, key information. If you don't file it in time, it is 100 rupees penalty per day. So your normal fee for if you're a small company with a small capital could be around 300 rupees for the form, government fee, but it goes up by 100 rupees every day. So you delay it by 1 month, you're looking at maybe around 3,000 rupees fine. Delaying it by a year, you're maybe looking at around 36,000 rupees fine for one form. And there are two forms like that which are done annually. And then there are other forms, which is ADT1, which is your auditor appointment form, which needs to be done within 15 days of the AGM. Again, similar fines are there for these forms. The AR3 KYC. So, what happened with all the Kingfisher saga and the Malaya running away from the country and all? There's something that came up. They said, when Malaya left the country, they said they didn't know Malaya left, and that's why they couldn't arrest him. Okay. So they didn't have any contact information. They didn't have any passport information. The government, the government, the ROC said, the violations are all in the Companies Act. ROC didn't have your details. They didn't have the passport details of Malay, and that's why he escaped. Is what was being said. And to fill in that gap, they said every year, if you have a DIN number, Director's Identification Number, every year you're required to mandatorily file a KYC form, updating your phone number, email ID, your Aadhaar card details, your passport number, and all those details. So this has to be filed by every director and every person who was a director and who holds a director's identification, the DIN number. Okay. So that's another form that needs to be filed every year. And then if you have MSME outstandings, there is a requirement to file a form every 6 months with the details of those MSME forms. So you have money to be given to an MSME, you need to file this form. And then there are other forms which are event based. So the other ones are mandatory for kind of forms, but these are event based forms whenever there is a change in the registered address, whenever there is a change in the address from one state to another, when there's a change in the share capital, when there's new shares being allotted, when there's a board resolution being passed for major decisions, when there's a director change, when there's a new director being appointed, when the company takes in a new loan, all these scenarios you need to uh, inform the ROC when you're taking a loan, when you're repaying a loan and closing a bank loan. These are all scenarios where you need to inform the ROC based on the transactions that happen. And now we move on to audits. So what are the audits that need to be done by a company? So the first of statutory audit. This is mandatory for all companies. Okay. So when I say mandatory for all companies, excuse me, yeah, any company incorporated under the Companies Act, whether there is transactions or no transactions, you are mandatorily required to do a statutory audit every year, irrespective of profit, irrespective of turnover, irrespective of transactions. One new clause that has come in, auditors have been required to report on audit trail. So any company doing their books of account, maintaining their books of accounts in the computer or an accounting software, that software needs to have an audit trail. So the government is saying you do your accounts, you do one filing, and then don't alter it. If you're altering any of the accounts that you're doing, make sure that there is a track to it is being tracked and it is being monitored, so that at any later point of time, any authority can come in and check and say, see, you had initially mentioned 100, now you've changed it to 10 to save your profits. So this is a violation. We need to catch you. So to make sure that people don't force their accounts, do alterations to their accounts, they put in a new clause called audit trail, which needs to be reported by the auditor. So the auditor has to verify the accounting software and see whether there is an audit trail happening, available in the system. And now, in the audit trail, for the points to note is, uh, if you look at Tally, it has audit trail. If you look at most Zoho, all have audit trail. So most of the common softwares have audit trail. Only thing is you need to add it to your system, make it switch it on kind of a thing. You need to activated in the software. Now, the next point is income tax audit. This is mandatory only if your turnover crosses 1 crore. So, if you're a company, your total income during the year crosses 1 crore, you need to get your income tax audit done. Internal audit again is mandated by the Companies Act, but comes in for bigger companies. So, the moment your turnover crosses 20 crores, or you have more than 5 crores in capital, or your loans are more than 10 crores, then you need to do an internal audit. The audit can be done by a chartered accountant, an external chartered accountant, or an internal chartered accountant, or internal team qualified to do the audit. And then you have secretarial audit, which are for big companies. Like if your capital is more than 50 crores, or if your turnover is more than 250 crores, you need to get a secretarial audit done. And then cost audit again is also for specific manufacturing or services industries, which is mentioned specifically by the government. So if you look at the license drug system, wherein where in the 1970s and 80s, cost audit was very important. You had all organizations mandatorily requiring cost audit, but now, as a part of liberalizations that happened in the 1990s, only a few sectors require cost audit. So if you are into any of these segments, like telecommunication, pharmacy, petroleum, sugar, cement, and all, there is a mandatory requirement for cost audit. The next slide. Yeah. Now, for statutory audit, what are the major documents required? So, as an auditor, I can tell you these are the things that basically we ask for when we go for an audit. Details of all bank transactions, details of all cash.
Hello? Hello, Hari. There is a problem at your end, I think. I am audible, right?
Yes.
നമുക്ക് ഫോളോ ചെയ്യാൻ പറ്റുന്നുണ്ടോ?
ഉണ്ട് summary wise it's okay based on what we want to actually drill into no adinu vera we ourselves will have to put in efforts. The overview wise it's fine in a nutshell.
Right,
I
he
think
has
it's
already.
very clear. I think it's very clear, but only thing is he should talk more about our kind of registrations and not about the,
See,
you know,
Aditya,
yeah.
like
Yeah.
I feel these are all startups, no? So basically, what he was talking about was the kind of entities, types, and all these forms, which actually they are not directly connected with, because normally they engage somebody, they file forms. But they would really like, what they would really like to know is, for the kind of businesses they run, what would be the ideal form?
Okay, that you can
As
ask him.
simple as that.
That you can ask him after
Yeah.
No,
covering the
Aditya,
topics.
why waste all the time talking about those things? Better to tell
No,
us.
Beena,
So, ma'am,
that
can
is.
can I disagree here, ma'am? As somebody who has already registered, you have to know all this, ma'am. Otherwise, we'll start a company thinking that we don't have much work to do. But once you start,
So yeah,
you'll know
Hari
that
is
there are
here.
lots of things. So you have to be prepared. So I think that this is because I came thinking, okay, registration, that's all done. You give two things and done. But you have so many steps after that. INCA filing, lots of things.
Okay,
So I
Amrita,
think
thank you, thank you. So I'm letting in him. Hari is already waiting there.
Hello.
Hello, hi.
Hey, sorry, some network issue.
Yes,
Yeah, I'll just share the file again.
okay.
Um, Yeah. So,
Pratik, your voice is not
I
clear.
think we covered audits. So we
It's
just
breaking.
touch upon. Oh, okay. How is it now? Is it still bad?
Yes, there is some problem, I think. Network
Is it
issue.
it's still bad, or is it audible
Now,
now?
now it's fine. Yeah.
Okay, so yeah, in case it doesn't goes back again, I'll try to connect to another network. Okay, for the
Okay.
timing, I'll
Yeah.
continue here. Okay. Another point that I wanted to brief upon during this session was on TDS. So there is something called TDS in Income Tax Act. So it's something that all entrepreneurs should be aware of. Whenever you make a payment of certain nature of transaction, the Income Tax Department asks you to deduct some amount and make only the balance payment to that party. And the remaining amount, that whatever you've deducted, you are required to deposit it with the government in that other party's name. And while the other party can claim this TDS during their income tax filing. So why did the government do this? There are two advantages. One, the government gets immediate funds. What it means is, if you are a person who files only income tax at the end of the year, the government will get only the funds at the end of the year once people file their tax returns. But if you have TDS, every month you're deducting TDS and you're depositing it to the government. So basically, the government is getting some advance amount for the year. That is one advantage the government has. Two, it is able to know what the revenue of the other person is. So when somebody deducts TDS, the government knows the other person has got X amount of income. So this information also gets to the government. And these are the two advantages of having TDS, and that is why the government has brought it in. And this is common across the world, whether US, UK, all have withholding taxes. So now, what are the nature of transact common? So this is not an exclusive list, but these are the most common ones where you will have to deduct TDS. Whenever you pay salary, if the salary of that person is more than the basic exemption limit, or more than the limit where he has to start paying tax, the equity of that employee, and deduct that amount as TDS. Whenever you pay a dividend or the profit share, and if the dividend exceeds 5,000 to a person, you need to deduct 10% tax. Similarly, when you pay interest, you need to deduct 10%. Whenever you give a contract, and this can be a marketing contract, this can be an advertisement contract, it could be a contract employee, all of that can come under 194C, which is contracts. And if a single payment exceeds 30,000 rupees, or in total for the year, if it exceeds 1 lakh, you are required to mandatorily deduct 1% if it's an individual, 2% if it is a non-individual. Say if you're dealing with a company or a partnership firm, it is 2% that you'll have to deduct. Now, similarly, insurance commission, if you are paying commission on broker, any other commission on a sale or something, have to pay commission. Then 15,000, if it's more than 15,000 per year, you need to deduct 5% commission TDS. Similarly, for rent, if you're paying rent of more than 2.4 lakhs, that's like 20,000 rupees per month. Then again, you'll have to deduct TDS at 10%. And if you're taking professional service, like a chartered accountant service that I do, if it's more than 30,000 in a year, you need to mandatorily deduct 10% TDS. So these are the common heads. This is not an exclusive list, but these are the most common ones, wherein you will have to deduct TDS as a business. Now, the next point, the points to remember, excuse me. Are you able to see this slide?
Yeah. Banking points to remember.
Yeah, but some things happen. I am not able to see the slide. Give me a second. Yeah. So now moving on to banking. Again, what are the major things that you need to keep in mind when you're dealing with a bank? There are two types of finances. One is term loans, which are long-term loans that are generally given for various projects or buying assets. And then there are working capital, short-term loans. Working capital is basically to finance your running activities. For example, if you want to buy inventory. If you're a trading business, you need to buy stock to sell. So these are the kind of places where working capital loans are given, and it needs to be backed by either debtors, or when I say debtors, it means customer. You need to give the customer who has to give you money, or if there is inventory or stock that you may need to maintain, then you need working capital loans, and banks give you working capital finance for that. Similarly, term loans are for buying assets. Now, if you want to buy, say, a plant and machinery or an equipment, you can get a term loan. Typically, the bank finances may be 80% of the loans, or maybe 20, and we ask you to take a 20% of the loan. I think there are KFC, Kerala Finance Corporation loans that give you 90% financing, and 10% is what you will have to raise on your own. So typically the point to remember, there should always be a promoter or the company's contribution to any of these loans. Bank will never finance 100%. Unlike, say, some of the car advertisements that you see, it says 100% road finance and all. Practically for business loans, you will never get 100% of the entire requirement. They will give you maybe 80% or 75% most commonly, and based on certain schemes, they might give you 90%. But at least the remaining 10% will have to be financed by you. Any bank or financial institution will ask you for a personal guarantee. So when I said unlimited liability, remember, your personal assets become liable for unlimited liability cases. For companies, it is limited liability. So your personal assets are not liable. But any financial institution, when you're taking a loan, they will ask you to give a personal guarantee also, which will bind your personal assets also. So it's as good as becoming an unlimited liability. Another point to keep in mind: never pay more than 10,000 rupees in cash for any business. Amount gets disallowed, and you will have to pay tax on it. 2, never accept more than 2 lakhs in cash from any other person, because the rule says the penalty is on the person who is accepting the money. So your customer might say, I will give you 2 lakhs in cash, you might happily accept it. But the moment you accept it, the penalty is on you, not the person who has given the money. The person who is accepting the cash, he gets the penalty, and the penalty is equal amount that has been collected in cash. So imagine you collected 2.5 lakhs in cash, the penalty is 2.5 lakhs. So basically, in your hand, you get 0. So never accept more than 2 lakhs in cash. Never pay more than 10,000 for an expense in a single day to a single person. Of course, if you have 10 people, you're paying 1,000 rupees each, no problem. Or 11 people, 1,000 rupees each, 11,000 rupees, no problem. But to a single person in a single day for an expense, never do that, because you'll have to pay tax on it. Never accept cash for more than 2 lakhs, because the entire amount goes as penalty. Also, for companies, the point to note is, for every transaction with the promoters and the directors and the shareholders, make sure that all the transactions are through bank only, because there is penalty mentioned in the Companies Act. Now, when you talk about startups, there are 2 types of accounts. You have the normal current accounts and you have the startup accounts. Most of the banks now have startup accounts, but initially they're good. But always keep in mind that after 1 year or 2 years, they change into the normal regular account. And that point of time, the triggers and the costs or the bank charges, everything comes in. So always be aware of that. Similarly, when you put deposit cash into the banks have started charging cash handling charges, which is slightly on the higher side, depending on your cash. And make sure that you negotiate or understand the cash charges or the bank charges before entering into banking transactions. I saw the questions. I'll take up the questions at the end, one at a time. Okay. Now, what are the other regulatory compliances that you need to maintain for your business? The IE code. Just give me 1 second. Import-export code. So whenever you're entering into a foreign transaction, when you're importing or exporting, you're mandatorily required to have an IE code. It is given by the Director General of Foreign Trade. It is an online application. There's a 500 rupee fee that they charge, and it's usually received the next day or the same day itself. Your PAN number gets registered there. Then there is GST registration, which is required when your turnover exceeds 20 lakhs or your revenue exceeds 40 lakhs. There is FEMA compliance, which is Foreign Exchange Management Act. When the company is taking foreign investment or external currency borrowings, which is basically loans from outside India, you need to comply with FEMA rules. Similarly, also if you're setting up a subsidiary abroad or if you're having a holding company outside India or something, you need to comply with the FEMA rules and regulations. Other registrations, ESI, PF, and professional tax. ESI stands for Employee State Insurance. The moment you cross 10 employees, you are mandatorily required to register with ESI. And the amount is 21,000. So if you have an employee who's being paid less than 21,000 per month, you have to deposit ESI with them. You have to register them with ESI and you have to pay the requisite amount with the government. Similarly, PF comes in when there is 20 employees or more. The limit is 15,000. So when the moment the limit crosses 15,000, the advantage is you can limit your contribution to the amount of 15,000. Shops and Establishments Act with the municipal registrations. When I talked about sole proprietorships, I said there is only a single registration that you need to take if you're into business, which is with the local administration, the corporation or the municipality or the panchayat. And this is mandatory for any organization. So, this generally comes in when there is a, what do you say, when you take a GST, apply for a GST registration, this is the common question that is asked by the officer, whether you have a Shops and Establishments Act registration, to whether it is a commercial building. So these are the questions that comes in when you are applying for GST registration. Now I have data protection to cover, data protection and IP rights to cover. Data protection, there are standards, there are ISO standards that are there. So what the cover is basically on information and data, how you need to maintain the data. So these are not hard and fast rules, nor does it prevent anybody from hacking or getting your information. But what it does is, if you've complied with these regulations and if you got certifications for these, it helps you in your legal fight. So it can save you from a customer giving a case against you or litigation against you. Even if there has been a breach, you can say we've followed the rules. The hackers did something better. They got the information. So we've complied with the rules. Is something that will help you. So these are never enforced upon standards. ISO standards are never enforced upon, but they help you in a litigation when it comes. But there are of course other standards that I'll come to in the other next slide, which are legally mandatorily required. Now, ISO 27001 is one of the most common and widely used international standards, and this is for information security management systems. It is a broad framework. It tells you how to establish an information system network, how to implement it, maintain it, and how to improve it going forward. Similarly, there's 27002, which is purely on security controls. So what are the security measures that you should bring in, and how do you manage those security measures? Like setting in passwords, how how often the passwords need to be changed. All those kind of things are controlled in ISO 27002. Similarly, there's an extension to ISO 27001, which is 27701. It is again a slightly more detailed version, and it is into privacy information management system. So if there are privacy, personal information or private information, and there's privacy regulations involved, the standard comes in. And then there is ISO 27018, which is the public cloud. When you're maintaining private data or personal data in public clouds, what are the rules and regulations, or what are the standards that you need to follow? These are all standards. So if you follow these standards, if you're business into technology sector and you follow these standards, this will help you in a litigation in case there's been a breach or violation. Also, it will help you in getting clients, because the bigger corporates, they make sure that you have complied with these rules before they give you any contract. Now, as I said in the earlier slide, the ISO is never an enforced upon mandatory standard, but there are standards that are mandatory. So one example is the GDPR. This is General Data Protection Regulation. This is by the European Union. So when you have European Union EU-based customers, when you have data protection rules that are mandatory, required to be followed in EU, or you have clients there, or your data servers are there, you need to mandatorily maintain this GDPR rules. Similarly, there are state rules also. For example, in the US, you have the California Consumer Privacy Act, which prevents or which tells you how private data has to be mandatorily mentioned. A similar thing is being done in India, but it's still in the making stage. Hopefully, it will be there soon. There are already some regulations in the IT Act which takes care of this, but a broad framework or the specific framework, I should say, will come in soon. And then there are industry-specific rules also that are required. Now, for example, the HIPAA, which is the Health Insurance Portability and Accountability Act in the US, it tells you how healthcare information needs to be managed. Also, the PCI and the DSS, data security standards, what they tell you is how credit card information should be maintained. For example, and it is applicable in India also. For example, all your credit, if I don't know if you've noticed, but Swiggy, whether you use Swiggy, Zomato, or Amazon, they give you an option to save your electronic card data, right? So that you need to put in only the CVV number or the OTP to make the transaction. To save that information, the credit card information, you need to mandatorily comply with the PCI and the PCI DSS, which is the data security standard for payment card industry. So these are rules that are there for either based on the location or the country that you are in or the state that you are in, which is geography specific. And then there are industry specific standards like these, which would be required for specific industries if you are entering into business with them. Now, another point that I've been required to talk about is trademarks and the IP rights. So I was not sure how much time I would be there to complete that. So I had not prepared a slide. So let's briefly talk about trademarks and IP rights. The reason is very simple. It helps you prevent somebody else copying your name, copying your font or name or logo or anything. And it is an online process in India. And when you do have that online process, it is much faster now. It takes only less than a year to get the trademark registered. It takes only a few months. So make sure everyone does it. And once you have a trademark, it also prevents somebody from having a similar name to that while forming the company also. So remember when I said company formation, they don't give you similar names to existing companies. They don't give names of similar trademarks also. So if you have a trademark, nobody can use that to form that name to form a separate company. So that is one advantage you have, and that is something you should do. And if you are a registered startup, there is a 50% reduction in the trademark fee of the government. So make sure you all use that benefit and you try to get it done. And another point is now moving on to patents. So patents, there is, I don't know if I should be saying this online, but the truth is the rules in India are very nascent. And when I say very nascent, they're very old. They've not been updated for ages. And in fact, I've heard there are Supreme Court judgments that say right to live supersedes any trademark or any patent laws. So, and there are cases where people have fought saying, I did not have any other method to live, so I had infringed upon this patent, and I and I've one of those cases. So patent laws are very. The answer is not in India. Register it first in India. It is easier for you to register it abroad. Is my voice still breaking now, or is it better now?
Now it's better.
Okay, great. So the advantage of registering doing patent registration in India, it helps you in easily getting the patent outside India. So you say the product has been developed here, you have an Indian patent, it helps you in getting the US or EU or any other patent, international patents, it helps you in getting it. And that is why registering the patent in India. So if you have a global product, try to do that. Register in India and then we go abroad. And I'm sure Startup Vision can also help you because they have schemes wherein they reimburse an amount for patent filings. So try to use them and try to get the patent filing done. And I'll also share one interesting thing in India that actually happened to my client, which probably explains to you how nascent or how bad the patent system here is. Okay. So this client had a very unique design for his product. He took a patent. And somebody copied the same design, made the same product, and started marketing it in the same markets. And my client filed a litigation. He won the case after close to almost 1 year. and there is no stay. So the other party also keeps on doing business. The stay, there's no stay, so the court case goes on. He wins the case. The other party still continues doing it. He has to wait 6 months to go to the court again, saying there is a violation of the court. Court election. So he waited for 6 months, filed a violation of court order by the other party. Again, another 6 month legal wait. The court asks him to immediately stop or take, or he'll be arrested. The guy stops the business. The next day, this guy who violated the business starts a business in his brother-in-law's name, does the same thing. This actually happened. And now, for my client, the only option was to file a fresh new litigation against the brother-in-law. And it's like going right from the start. Go for 1 year, and then there'll be a violation. And then, probably that other brother-in-law's name, he'll start the business again. So this is how bad the situation was for patents in India. This is a true story. This happened a few years back to my client. So registering patents in India may not be very valuable if you're doing business in India alone. But if you have an international product, go for international patents after registering it here. So on this note, I hope I did justice. I've taken 1 hour 10 minutes, close to 1 or 10 minutes. I'm open to questions for the next 20 minutes. I'll be happy to take any question on any of these topics. Also, anything that you feel a chartered accountant might be able to help you with, feel free to ask. Thank you.
Lots of topic you have shared. I'm not sure everybody how.
You had given me a tough task of putting
I'm
in all those topics.
sorry.
Yeah. So, and as I said, these are all topics that are probably worth taking 1.5 hours to 2 hours, or maybe
Understood.
even half day. But so my idea was to just give you an introduction to everything so that somebody talks
Yeah.
about this, you know what it is. If at most you've not understood anything, I hope I've created a confusion to all so that at least chartered accountants and professionals like me have a better job.
Okay. There are some questions from Pooja. Pooja, if you can unmute and ask, it would be great.
I
I'm
can see
reading
those
them.
questions. Yeah, I can see those questions in the chat. I can take them one by one if you want.
Yeah. One
Do
question,
these
Apple.
banking- Yeah. So
Do
do
these
these
banking
banking
transactions?
transactions
Yeah.
rule hold for single
Yes.
person proprietorships also? Absolutely. If you have a current account, so when you have when you're a single person, the normal person has an SB account, but banks prevent you from doing too many transactions in an SB account. So because of that, the moment they'll ask you to open a current account, these transactions rules are applicable to current account also. And
So
then I
for
have
which question you were
2
answering?
questions from my side. Sorry?
Which was the question?
It was the earlier question which I had
First
posed.
one, yeah, okay. Understood.
Yeah, so I'll just take the other questions. Yeah, I'll take the other questions also. What is the regular trajectory of startups that you have seen? How do people generally start with sole proprietorships, move towards partnerships? So there are 2 ways. So how many founders are there is the first question. Okay. So if you are a one person, then sole proprietorship works well. If you have more than one person, it is mandatorily that you need to have at least some sort of organization where both of you have ownerships. So you can start off with a partnership firm. But if you are in very good rapport with them and there's not much money investment involved, even a simple agreement between both of you would be sufficient. Even if it's not a stamp paper registered partnership firm, and if you're not looking at taking any benefits from Startup Mission or the Startup India scheme, a simple agreement can also work well. And once you have a product developed ready, once you have a customer who's willing to pay, or if you are looking for a benefit or a scheme or a grant that you mandatorily require to develop, at that point of time, you can look into moving into an LLP or a private limited company. So this is what I would suggest. This is what I normally suggest also to any startup that comes in. But generally, the attitude is to start off with a private company right from the beginning, because the expectations are that in 3 months I'll get funded, 6 months I'll start making money. So those are all expectations, but I'm not discouraging any of them. But the point to keep in mind is that does not generally happen. Next question, which registration has least amount of hassle or harassment to begin with? Again, as I said, the moment you get into an LLP or a private company or one-person company, there are much more rules to be followed. So if it's a proprietorship partnership, it is simpler to manage the business. The next question is, which registration has the least amount of hassle or harassment? Okay, I took that. Would you advise beginning registration process before the product is ready? So again, the point is, do you need grants or funds, or are you looking at any of those methods to develop your product? So if you're, for example, you need a mandatory BIRAC grant, or if you're looking at a startup mission grant to start off your business, then there is no option but to register and get a Startup India registration. But if you're into a tech product company, you are the one who's developing it, you are capable of doing it, then there is nothing wrong. You can delay that process and do it once you have a stable product or a stable customer, or whenever you're able to. I know, as I said, there's a compliance cost involved right from the beginning. So whenever you feel you're able to meet those costs and expenses, you can go into a company. What type of person or firm should be hired? How to judge? Oh, that's a question for an HR executive. I shouldn't be answering them. But yeah, so see, from my take as an employer, I look at the attitude one, because knowledge is something you can learn, but the attitude is what I look at whenever I'm hiring a person for my office. If we have the attitude or the willingness to learn, then I hire them and I can train them. So that is what I look at.
Sorry, sir. What I meant was the CA firm.
Oh, okay. CFO. Okay. See, there are two things. So, I think now there are a lot more chartered accountants who are into CFO, I mean, startup practice. So, there are quite a few consultants. But again, I think if you look at Startup Mission, they started something called Startup Commons, wherein they are listing out chartered accountants who work. I think the work is still in progress. Aditya might be able to show some light on it. But maybe I heard this month or next month they'll have a list of chartered accountants that they're empaneling. So what I believe is they would be people like me who have some experience working with startups. So I think that would be the right place for you to go.
Got it. Thank you.
And then what type of person? Okay. Which option has minimum personal liability? Company, limited liability, OPC, LLPs. These are limited liabilities. But the point to notice, just like when I said, when you apply for a bank loan, they ask for a personal guarantee. So if this doesn't work when you give a personal guarantee, then the personal liability already comes in. But otherwise, it is LLP, partnerships, OPCs. They all have limited liability. Can we get perpetual succession for sole proprietorship? No, you can't, because the person is the business. So when the person dies, the business automatically comes to an end. So there is nothing that can be done. It has to be a fresh registration in your legal hire's name or whoever wants to continue your business. So that history does go.
Thank you, sir. Yeah.
Thank you. Yeah. Any other questions? Sarah, okay. Okay, there are more questions. Let me
What
just
are
go
the
down.
filings necessary for an
Yeah.
MSME?
What are the filings necessary for an MSME registration for business? See, MSME does not mandatorily require you to have any filing as long as you've taken an MSME Udyam registration, which is an online form, very simple form. All of you can do it alone. You don't need to go to a consultant for it. It is based on Aadhaar. You can register it. You can get an Udyam registration. There is no other filings required for an MSME. But because if you are registered as any other entity,
Lost
you're
your
an
voice. Lost
MSME,
your
which is a
voice.
private company, then you need
Hari,
to follow the rules of
Hari,
the
you
private
lost your
company.
voice.
If you're an
Can you-
MSME with as a proprietor, hello.
Lost your voice
Okay.
when you were
Okay.
answering that.
Is it better now?
Yes. Yes.
Okay. So, as I said, MSMEs specifically do not have a registration requirement, but it depends on the nature of organization that you have registered. So if you're a partnership, there is an IT or an individual sole proprietorship, you have to have an ITR filing. If you are a company, then ROC and income tax filings, GST filings will be there. So basically, it is not relating to MSME, but the nature of organization that you've registered. So just because you're an MSME, there is no difference to the filings.
Thank you.
Then, is it easy to convert an LLP to a private company for an IT product firm? It is possible. It is absolutely possible, and it is slightly consuming. So it might not happen very quickly, but it is possible. But if you have a couple of months runway, you can convert your LLP into a private limited company.
Okay, thank you, sir. Or do you
What
suggest
is the
winding up the?
commencement of business certificate? Yeah, sure. Go ahead.
Yeah, I had asked that LLP to private conversion, or do you suggest winding up the LLP and then starting private altogether? I'm not sure the pros and cons, or maybe can touch base with you later.
It really doesn't make a difference. See, if you have violations that are there in the LLP, if there are some legal violations that have happened in the past, some delays or filings or anything, start on a clean slate. It might be better off to start a private limited company and then cancel the LLP. But
Sure,
otherwise, it is okay to convert the LLP also. There is no
sure. Thank
issue
you.
as such. Uh, the next question, what is commencement of business certificate? So the moment a company is incorporated, you are required to deposit the capital amount and then file a form. And this is called commencement of business. Now, I don't know if you're aware, a lot of companies got penalty notices for delay on this commencement of business form. So this has to be mandatorily filed within 6 months of incorporation. The first step to do is open a bank account, put the capital amount, whatever is the promoters, whatever they had promised, put that amount in the bank, take the bank statement and file this form. It should be done mandatorily within 6 months. And the actual activities of the business should start only after filing this commencement of business form. If you don't do that, you're looking at a huge penalty. It can be 50,000 up to 50,000 for directors and up to 2 lakhs for 1 lakh for the company. So there's a huge penalty involved if you don't do it on time. And a lot of startups have got it. It has all been stayed by the government. There's a court case, there's a litigation happening, but the rules say the penalty is applicable. So the government is looking at it from a slightly trying to relax that portion. But as of now, the rules still exist and there is penalty involved if you don't do it in time. Can GST registration be done for individuals working on contract with companies? Yes, it can be done. If registered, can the income GST be filed? Yeah, yes, absolutely. So basically, GST and income tax cannot be linked. Both are different acts. GST is on the total amount that you've collected. Income tax is on the profit. So both are different. Both are as per different acts. But the question, the answer to the question that you asked, yes, GST registration can be done for individuals working on contract with companies. And it is mandatory if the contract value is more than 20 lakhs. If you're providing a service to a company for more than 20 lakhs, as a consultant, as not as an employee, you are mandatorily required to get a GST registration. Why would freelancers prefer one-person company if there is so much? Absolutely. If you see, the number of OPCs are also very less. And that is the reason why, one of the reasons is the high tax rate. The only advantage is limited liability. So imagine you are entering into a contract where there could be a major liability on your head if you don't perform well. If you enter into a contract like that, then it is important that you segregate the liability from your personal assets. Or if you're entering into an agreement with the government or something where there are major issues, but these are, I don't know if you're familiar, but there was a company that I was working with. They had a contract with ISRO. When the terms and conditions of ISRO was so stringent that for delays, there were 1 day delay, there was a penalty of a few lakhs. So when you enter into those kind of agreements, it is important that you segregate that liability from your personal liability. And those are scenarios where you might move into a one-person company. Next question, can a person be closed once? Can a company be closed once established if we cannot pay for compliance? Even closing or winding up company costs money. So in simple terms, it costs you a minimum 20,000 rupees to close the company. And the sad part is, even if there is a form file pending to be filed, those files, all those filings will have to be done before the winding up is done. So when you wind up the company, there are, imagine, understand that there is cost involved and it is time consuming also, and whatever for the winding up. I hope I've answered those questions.
Yes.
Is there anything that I missed out on?
No, sir. Thank you.
Any further queries? Could we take your email in case of doubts?
Sure, sure.
I'll share Hari's email with you.
I've put my email ID there. You can also reach out to me on WhatsApp. I may not always pick up the phone. That's my phone number. You can reach out to me on WhatsApp. You can just introduce yourself. You say that you're part of this session, and you can put in your questions. I'll be happy to. Usually, I try to answer all those queries within the same day, at max by the next day. So, in case I don't pick up, you can always use this WhatsApp number.
Can I ask a question? So,
Yeah, go ahead.
the Shops and Establishment Act, is it the mandatory registrations you said, right?
It
So,
is a mandatory registration. Yes.
is it for
yeah.
private limited and OPCs also? Hello?
Yes. See, if you look at the rules, yes, but it is not enforced as of now in Kerala. So only traders are now being enforced by these corporations and panchayats because they can see that organization there. But legally, yes, you are required to get that registration. But as of now, because it is not being enforced, people are not taking it.
Okay, thank you.
Sir, one more question.
Yeah.
If we have to like if we are working as a freelance, I mean on contract for a company, and then we have to take GST, do we have to
Mhm.
take this Shop and Establishment Act? I mean, do we have to register for that?
No, so yeah, so basically, as professionals, you can get an exemption. You can say that you're an individual consultant working from home. You can get a GST registration in your home address. That should be good enough. You wouldn't need this Shops and Establishments Act. But the moment you start trading in goods, it becomes mandatory, and they'll enforce you to do that.
Okay, thank you, thank you.
Yeah, okay. Aditya, can we probably try to get a group photo or something taken, a screenshot?
Yeah. Hari, your screen is still visible. So can you please
It's not
close that?
visible?
Yeah.
Oh, sorry. I didn't notice that. Yeah.
So can we all have your camera on? Meera, Deepa, Vinci, Shibina, Shabina, Roja.
You'll take a screenshot, Aditya, or should I do that?
I'll take it.
Okay, great.
Yes. Deepa, Meera, Shabina, Vinci, we are waiting for you to turn on your camera.
If it's difficult, that's fair enough. We shouldn't be forcing them.
Okay. Done.
Thank you. So
So
I
I-
hope I did justice in the 1.5 hours that was given to me. So thank you once again, Aditya, for having me for this event. Thank you, KSUM. I know you guys are doing a wonderful job. Hoping to see you at Hurdle.
Yes. Thank you, Hari. As I already mentioned, there are lots of information you have shared. I hope the
I'll share the
PPTs.
PPT also. Yeah, I'll share the
Yes,
PPT also. You
yes.
can share it with them.
Yeah, I'll share it with them and the recordings as well. If many things he have shared more than the PPT, so I'll share the recordings as well with the attendees only.
Sure.
Okay. Thank you, Hari. Thank you so much. And I'll connect. I have got some requirements from the team members as well from this cohort 2 participants. So I'll connect them individually with you.
Sure. Okay.
Yes.
Thank you so much. Thank you for
Thank you.
bearing with
Thank
me
you.
for the last 1.5 hours. Thank you.
Thank you, Harry. Thank you all. Thank you. Bye.
Thank you.